Welcome to Asset TV's Fund Fit Summit, 10x Investments, with me, Joanne Baynham. Today I'm joined by Anton Eser, Chief Investment Officer, 10x Investments, Florbela Yates, Head of Equilibrium, Warren Ingram, Executive Director and Co-founder of Galileo Capital. Welcome to you all. Today we're talking about the 10x Income Fund, and as probably many of you are aware, fact sheets don't tell a whole story anymore, so we're getting fantastic feedback for these Fund Fit Summits. So Anton, as the manager of this fund, tell me more about it. What's it trying to achieve, or what is its benchmark?
Joanne, the fund is what we call an income solution. So we are trying to deliver an outcome, and the outcome is inflation plus 2.5 net of fees. But we also benchmark the fund against cash as well, so cash plus 1% in the portfolio. So both of those are kind of objectives for the fund. As you would expect, it invests across a portfolio of fixed income securities, so government bonds, money market instruments, corporate bonds in the local market, and we can invest up to 30% of the portfolio in global corporate bonds and government bonds as well. As you would expect, really, with the strategy, it's very focused on risk management. So for investors in this product, capital preservation and not incurring losses is really a huge priority for what we're trying to do. We're not talking about volatility. Volatility is one thing. I'm sure we'll get into that when we kind of go into the discussion. We're talking about loss of capital. So loss of capital obviously is what we want to minimize. And just continue to deliver a real return, a real income on the portfolio. We don't in the sector. You can invest in equities. We don't. We keep it very much in the fixed income world. As 10x invests, we're very focused on asset allocation. We're not stock pickers. We're not tactical asset allocators. We're very much looking at long-term asset allocation in terms of how we run the portfolio, and I'm sure we'll unpick that a little bit when we go into it in terms of what that means for fixed income, because it's different compared to equities. And I think that's really the big differentiator for us, is that for us, costs are super important. We want to maintain a low cost base on the fund, because costs really do erode returns, and focus very much on kind of long term. It was launched in a unit trust a few years back, and then last year we launched the first actively managed ETF. So the same strategy, but available through the JSE. So for private wealth managers, stockbrokers, individuals to access an income solution through the exchange alongside their equity exposure is what we provided for with the ETF. So yeah, that's the strategy. Okay, and the unit trust versus the active ETF, are there any differences? Subtle differences. The underlying portfolio is the same. There's differences in terms of for example, the income distribution is monthly versus quarterly on the ETF. There's small differences in terms of the way an ETF trades with a market maker compared to the way a unit trust is creation and redemption of units. But otherwise, they are the same. It's just a different wrapper and accessed by different clients. Okay, but the main difference is one is monthly and one is quarterly income. Yeah, basically. Absolutely. Yeah. Okay. Yeah. So income funds have always been seen as safe assets, Florf, and I think a lot of people, especially in the corporate bond space, have hidden a lot of the risks in income funds. Do you want to tell me more about what you're seeing in the income space generally before we start talking about 10x and things that concern you, perhaps?
So I think maybe the first thing to say is that the multi-asset income space as a category is not homogenous. It looks very different. There are very different strategies and types of funds in there. So understanding that is probably the first place to start. The second thing is that within the income space, you get different strategies, and we typically would prefer not to constrain managers. So we pick funds where the managers make those decisions. They're closer to the coalface, and we would pick a manager that is able to do that. And we rate 10x quite highly in this space. And then we look for managers who are doing things differently. So we need to try and understand, are they looking for duration? Do they invest in corporate paper, government paper? Do they have any credit exposure? And at the moment, credit's quite topical. We've had one particular fund that had a large exposure to credit, more than what is normal in the income space. And so if you invest in credit, you're looking for high yield, and we like credit as a strategy, but it's important to understand what type of credit you're getting and how the manager's risk process works. Do they have a limit in terms of the paper they get exposure to, or limits in terms of industry and the like? So we'd look at that. And then from a portfolio construction perspective, it's important that it's not all sitting in one. So we don't only want managers that focus on duration, or only focus on credit, or only buy government bonds. And putting it all together in a way that manages our risk. And to your point that income's always been seen as a safe space, I think that going into COVID, certainly for the first time in my investment career, we saw income funds giving you a capital loss over a very short time period, a couple of weeks to a month, which isn't common, and that's probably where the perception comes from. But there is risk. If you invest in credit, there's always risk. And credit events happen all the time. It's just not publicized because they're small, typically, as part of a larger portfolio. Hence why it's important to understand what the credit process behind it is. And they can give you a loss. It's not sitting in a bank backed by a AAA rated
But just to
instrument.
interrupt you there for a second, Anton mentioned volatility is not the loss of capital, I think earlier. When you say loss, are you expecting it? Would you still be comfortable with an income fund that had a drawdown, not necessarily an absolute loss, but a drawdown for a couple of months, but then returned it again because of market volatility, but it isn't because credit went belly up, for want of a better word? So just talk to me how you think about from a volatility versus capital loss perspective.
So it depends very much on the mandate that you're investing for. Now, for clients who are drawing an income, you don't want any capital loss. So in your living annuity clients, we'd be quite conscious of that. But absolutely, there are drawdowns, and it depends over the time period that you're looking at. We would be comfortable with that, is the short answer.
Okay.
But the mandate also determines how much of a drawdown we're willing to stomach. And we'd even look at things like how much offshore exposure there is in the fund, because sometimes the rand volatility can also give you a drawdown. Remember that investors will only experience a capital loss if they disinvest when there's a drawdown. It doesn't mean that you're actually seeing a capital loss if you stay invested over a short time period. It normally comes back. But we would look at all of those things. And then from a portfolio construction perspective, trying to understand how funds do in different market cycles is very important. So when interest rates move, what impact do you expect the fund to have? And then at portfolio level, is that something that our advisors and their clients can stomach?
Well, talking about advisors, we have an advisor here on my right. Warren, who are these products correct for? Which kind of client would you put income funds? All your clients?
I was going to say it's an interesting question, because talk about volatility, and I think for a private client, some of whom are simply looking for the biggest return on cash that they can find, they would be attracted to an income fund and would have no understanding the moment they see a loss for a month. And would be, I think, hugely unsettled. And it's a valid point. You only realize the loss if you sell, but they're going to sell. So I think that they do see it as sort of a homogenous entity. They would say this is the same as a money market fund, probably not too different from a bond fund. So I think understanding the level of education of the end investor is important, because my kind of scar tissue comes from the African bank debacle, when you see money market funds, in theory, pretty much no risk, taking a loss. And in my career up until then, I would have thought they were safer than houses, not as safe as houses. And all of a sudden realizing that a money market fund is a thing that represents a potential for capital loss. And I don't think it happened in our history before then, where we saw a fund write down. So I'm getting to your answer. But I would think it's not one thing. It's not one type of client. So inside an income drawing client, so inside a wrapper, whether it's a endowment or a living annuity, and especially a living annuity, where you're looking for income, it's a very nice stabilizer. So I would think that for a lot of people who need a fairly high level of income out of a portfolio, that an income fund would play a critical role. It wouldn't necessarily give you the inflation protection. So I don't think it would be the only asset inside a living annuity. And then people that are looking for a parking place for longer than 6 months, potentially a year or longer. So, if I'm saving up to buy, I can't say to buy a house, to put down a nice deposit on a house, and that's going to take me 4 years, then potentially an income fund becomes the place that I would look at. Or if I'm going to save up money every 3 years to buy a car, income fund becomes a nice place. I think in the kind of institutional market, very different, because then you can use building blocks and take an equity portfolio and do your own asset allocation. But I think for an end client, they would want the benefit of a packaged solution, and that's the point. You're talking about a solution. So I think that it would fill a need. I'm not sure that it would help be there for every client. There's no way I'm putting a 30-year-old high growth client into an income fund unless they have a need for a specific expense in a fairly short space of time. Couple of years at most.
Okay. So
can I maybe just add to that?
Please do.
I think it's also important for multi-managers and DFMs to understand how the advisor structures portfolios for their clients, because that would also determine the type of funds you'd use in that solution. So even in the living annuity space, you need to understand what the time horizon is, and all those sort of things would also something that we look at when we look at income funds or income solutions within client portfolios on behalf of advisors.
And I'm glad you talk about risk a lot, because I think now that would be on the radar. People would be aware, at least advisors would be much more aware than in the past, that there is capital risk. And maybe I would be adding, as an advisor looking at an income fund, the moment, I know we don't, it's not a horse race where you're comparing, everyone against their kind of peers, but at the same time, if one fund is doing 2% a year better than everybody else in a space where 0.5% a year is amazing, then you have to ask questions. You should really be saying, what on earth is going on? And I think you mentioned cost. So to me, if you ask me how I'm going to choose that fund, I'm actually going to start with cost first. And the 50% most expensive funds are out, because I think in this space, there isn't as much room to maneuver with a real active space, to then absorb those costs. So I would only look at the half of the grouping that are low in terms of fees, and then risk management. That has to be the most important skill now.
So Warren, you brought up a really good point about fees. Clients today are looking at income funds or money market funds and getting very high yields, because we've had very high interest rates in South Africa for a long time now. Is it difficult for a financial advisor to justify putting a client in an income fund and then taking their fee off it when the client can go directly to the fund? So what is the advice you give to people who say, I'm saving up for 6 months? Do you sit there and say, look, I can suggest this fund, but I also suggest not using a financial advisor until such time as you want to invest? Because once you take all the fees out, to your point,
yep,
it gets very difficult to outperform what the client could do themselves.
It's easy for a good advisor, because all they say is exactly what to your point. This is a short-term objective. The simplest thing for you to do is open up the account yourself. Do this. There's, to take a 1% a year advice fee on money that's going to be parked for 6 months or a year. I'm sure there are advisors doing it. I'm not sure I'd call them good advisors. So
I wasn't asking for an ethical call yet, Warren, but
it's a
I'm
good point.
teasing you. I just, because you mentioned cost on the one side, but there's costs on the other side too, particularly in income products.
It's our job to get them to charge as little as possible, so we can charge as much as fairly possible and get the best outcome for the client.
I think let's get back to the word best outcome for clients.
That's the key here.
The reality is that we have the best outcome for clients, everyone wins, because then they come back.
Yeah.
Okay, but the fees are important. Just back to this particular income fund. First of all, what is the current yield on the fund? What's your maximum duration limits that you're allowed in the fund? Because we haven't really discussed that at all. And you happen to mention you're doing global credit. People have very strong views about global credit at the moment. So starting from the top, what's your income? What's your interest rate you're getting on this fund, your effective yield? Yeah. And then what's your duration?
So the yield, the gross yield is
Yes.
10.1, and the total expense ratio on the fund is 0.32. So net is 9.8-ish. As I mentioned earlier, it's a 3-year outcome, so we limit the duration at 3, because that's kind of the time horizon that we are working towards. And if you take 3-year inflation at the moment, it's around 4.25 or so. So it's 3-year inflation plus around, let's call it 6%, 5.5–6% in terms of what the yield is currently. And bear in mind, with the 3-year duration, that yield is pretty much locked in. The element which we'll talk about is the inflation risk, which is left around the product. The third question around global credit, it's something very close to my heart. That's what I kind of spent my whole career doing, living through and managing credit funds through the global financial crisis, and in a world where spreads were tighter than they are right now, but not very different to what's going on at the moment in terms of credit markets. It's a fantastically diversified, huge opportunity set compared to what we have here in the local credit market. So for a product like this, being able to access global credit is very useful at the right time in the cycle. Right now, that time isn't here, because spreads are, your risk premium for credit is very low, like you see in lots of equity markets as well. So the opportunity in credit from our perspective is limited. But when we do invest in global credit, we by default hedge the currency risk. It's an income fund.
Yeah, that's my next question. Because
exactly.
You don't want to be getting that 10 bips extra yield and get blown up by the currency.
That, especially in investment grade credit, where you have your volatility is limited, and it's very much a function of duration. Look, high yield is a different story. So when you allocate to global high yield, actually having some dollar risk in the portfolio is actually an offsetting risk mitigation tool. So we will, in those cases, when we allocate to global high yield, we'll probably run a little bit of a currency position, because it actually reduces the volatility of the portfolio. But otherwise, we're not taking any FX views, and FX is right now we have some linkers, some tips in the portfolio, US tips in the portfolio, so US inflation-linked bonds. But that currency risk is hedged, because we just want to lock in the real yield that we have in the US market. So, as an example, it's always hedged.
And just back to sort of the interest rate view that we're getting in markets at the moment, people are expecting interest rate cuts, both from the US and other central banks around the world, and the SARB will follow, hopefully. Are you swapping fixed for floating? Are you doing a bit of this, trying to take advantage of these higher yields and offer at the moment within the fund?
Yeah, and we have pretty much for the last 6 months. So we've been close to that duration limit of 3. It's made up of both nominal duration and an asset class, which I love at the moment, which is our SA inflation-linked bonds. It's just the most fantastic asset class I've seen in my investment career. You can generate inflation plus 5%, 6%.
It's on the longer end, isn't it?
No, it's not actually.
Because the guys tell me it's the short end is the nominals are better than the inflation.
Other way around.
No, they've shown me graphs that,
okay, we can definitely go into that. I'd love to have that conversation.
Anton, I'm about to fight with you on this.
No. It's the front. The 0 to 4 years in the linkers is inflation plus 5 or 6, whereas it kind of flattens out. So your inflation premium actually gets worse the further out you get into. So you want to actually hold nominals, which we do kind of 8 to 10 years, and you want to hold linkers at the front end and just hold them, put them in the bottom drawer.
So how much do you have in your fund of that?
We've got 30%.
30%.
Some of those are in a very illiquid bank inflation-linked bonds, which we love as well. You're getting a premium over and above. But you need to be mindful of the liquidity in linkers, because they are more illiquid than nominal government bonds. So, from our perspective, we can invest up to 40% in inflation-linked bonds. We are mindful of the liquidity of that asset class. But it's for a portfolio which is looking to generate CPI plus 2.5%, and you can get
sounds like a no-brainer.
I'm kind of scratching my head.
Yeah, okay.
I've worked in global markets where you earned inflation minus for most of your career, and here you have this fantastic opportunity. So, and just the final point, credit is something we hold. Next to nothing. We hold a couple of % in credit, and we winding that down.
And that's in the South African context you're talking about, no? Just generally,
right across the board.
Right,
so a little bit
board.
of SA credit, and it's a highly fragmented market in terms of the supply and demand dynamics, and the spreads are very tight. So there's very little kind of opportunity at the moment in the local market. So the credit element's low, linker element high. And then we have a barbell where we hold nominal bonds kind of closer to the 8 to 10 year, and that's how we get to that 10.1% gross yield.
Okay, it still amazes me how much people make in income funds in South Africa. And I think it has long-term implications for our economy with the yield so high, but that's another argument altogether. Flor, Anton brought up a very good comment there. He said, we limit it to 30% because even though I'd like to get to 40, I'm very mindful of liquidity around the fund. Is this something you analyse when you look at income funds? Because if there's a run on the income fund, suddenly people, because interest rates are cut and somebody wants to sell income funds to buy equities, for instance, as an example. Do you think about this? Is this something you analyse?
So when we analyse funds, let's maybe take a step back. To analyse a manager before we get to the funds that we use, we follow a qualitative and a quantitative approach. So from a qualitative perspective, it's quite an in-depth process, but very simply, it's about people, process and philosophy. So on the people side, we'd spend a lot of time understanding the skill set within the team. So I hear Anton saying they invest in duration, in nominals, in inflation-linked bonds, and in credit. It would be important that if we're going to invest in the 10x income fund, that we believe they've got skills across all of those subsectors within the income space. Process is about how do they get access to them. So something like inflation linkers, they are liquid. There's not any new issues coming into the market. Are they holding them for long periods of time? If they do want to exit, how do they do that? How quickly can they get in and out? What position sizes they have? Do they have limits from a risk management perspective? So credit might give you great yields, but it also comes with a lot of risk. So we'd have to understand what the process is there. Do they have limits in things like per industry, per structure, or each piece of paper, type of paper that they hold? Things like the ratings on the different paper that they hold. And then philosophy is how do they then construct their portfolio? Do they have asset allocation skills? How are they making the offshore calls? Are they hedging any of the currency? All of that. So we would look at all of those things. And then we would, if we decide we wanted to invest in the fund, we'd then have to go through a quantitative process where the managers would give us their holdings through time so that we understand how they've done in different market cycles. And it's great to know what they hold now, like Anton's just shared, but it's also important to know what they've held at different points in time, what the turnaround is in the portfolio and that. And then liquidity is important in the income space. Remember that if you're investing through a unit trust, typically you have fairly high liquidity already, but it's important that the paper in there isn't going to create a liquidity issue or a run on the fund. I think that's where risk management comes into play. And for us as a multi-manager or DFM, we would always look at the portfolio level. So we don't typically only invest in one income fund. We'd have a couple of different funds, and that already mitigates some of the risk. For example, credit is something we do like. We would be much more comfortable with a fund like the 10x income fund that holds local and offshore credit and not only local credit, and then understanding where the actual exposure is, so that if credit events happen all the time. I think investors don't realize that, but they're credit events all the time. You just don't hear about them because they make up such a small component of a typical income portfolio. But if it's a huge component in a specific fund, that would be a concern to us. Or at a portfolio level, we could actually hold only a credit fund or an income fund that has mainly credit, but we would typically balance that then with another fund that focuses more on duration, or a fund that has a more conservative approach. And at the portfolio level, we'd manage that.
So back to portfolio level then, Warren, would you choose two income funds for a client, or would you generally pick one income fund for a client, as to what Flof was saying earlier, or is that more of the DFM multi-management space?
No, I mean, I think I would never choose one. I think I'd be hard pushed to just do one. So I think I don't know if it's wrong or right, if it's just intuitive that three feels too many, but two just from a simple diversification. If something goes wrong with one, you're hoping that the other manager hasn't made the same set of mistakes. That there isn't groupthink, so that we can deal with some of that liquidity if there is an issue. So for me, certainly two is kind of a golden number.
And just more esoteric question, conservative clients have been very lucky for many years in South Africa because income funds have given great returns. If we start seeing interest rate cuts, how is that conversation going to evolve for clients to say, you can't rely on that income anymore to give you that return, because when I hear that an income fund is giving you 2.5% real, it's pretty impressive. So if going forward that becomes 1% real, they have to look for other places. How do you think about that with conservative clients?
Well, I mean, even Anton wouldn't put all of his money into one, right? He'd still do something else. So to me, I think if you've got high income clients, only allocating to income funds would be the mistake. So as their income from the fund is reducing, one hopes something else is compensating. So you're getting some capital growth, let's say, through a kind of a more cautious, balanced portfolio to compensate for the reduction in yield. But I think it's a very healthy thing if we start getting lower rates. It feels to me that, I know we're spoiled, but actually the economic cost to me feels...
No, it's huge. It's huge.
Astronomical. So I'm quite excited if we're sitting here in this studio in 3 years' time complaining about, we can only get 0.2 above inflation right now, and that's an incredible job. Then we're in the golden space. Things have gone better.
No, I don't disagree. And what a lot of income funds have also done, Warren, lately, and I'd like to hear your input into this, and it worked for a long time when the rand was weak. They had quite a lot of dollar assets kind of hedging out, their 10-year treasury, holding long-term paper in South Africa, and then they hold dollar assets to mitigate that. And then we've seen recently with long-term paper coming back quite nicely and the rand being strong, so you've got to... What do you think about income funds that play in that space?
I'm worried when they don't hedge. I think that to me feels...
So you want to get hedged back into rands, is what you're saying? Yeah, okay.
So now you're taking... To me it feels like equity, like volatility or risk, whatever you want to call it.
Yes.
I get stuck in the jargon, and you're putting that into the income space, and that feels wrong. So I think if they're hedging out the currency, at least that volatility of the currency becomes non-event.
Okay.
I'm not sure I'm clever enough to understand that if the US credit market changes phenomenally, that it's going to affect, or how it affects us. I think that's why you've got...
We'll leave that to Anton.
The brighter people in the room. Having said that, I think right at the end, the individual investor, the person who actually we're talking about, or to, they're also not going to understand. So what they want to know is, I expected 9% or whatever it was, and now I'm going to get 8%. And I haven't seen a permanent loss of capital somewhere here. And to me, that's really what I'm going to be focusing on. So I want to know always that, are we really taking capital risk, number one? And number two, I don't like the currency then becoming a factor in that. So we've got to hedge the currency out. But number three, let's not replace kind of a income mindset with equity volatility because we ended up taking huge credit risk or something actually.
Okay, let's bring the manager back in. So talking about risk, and you talk about risk mitigation, has there been times in the history of this fund where you've underperformed money market funds? So some of the decisions you made didn't work out. You still had a positive return, but one would have been better in money market. Has that happened?
Not yet. But we have been only running the strategy for 19 months or so. So,
Okay.
never in that period of time we'd reached the peak of the hiking cycle, and, obviously the expectations have kind of come down in terms of where rates are going to be going. So yeah, we haven't. But as I mentioned in the beginning, we do have twin objectives around ensuring that we're still generating cash plus yield return and our inflation outcome as well. So we're looking to optimize both of those. I just wanted to extend one thing what Warren was saying. Like the thing about this industry, often portfolio management, is sometimes you have to be busy and you have to be doing things, and you have to be investing in different asset classes and bringing in notes and doing derivatives and investing in credits, and often you have big credit teams who need to justify their existence and all of that. But actually sometimes in a cycle, simple is the best thing. And in the income space, simple right now is the best thing. There will be a time when, and I do believe real yields are going down, for maybe there's an emotional element of that as well for all of us, because then equities are going to go up and investment will happen and all that. But actually, we do actually justify in this country, given just how incredibly stable our inflation has been for the last 20 plus years, we actually do justify lower real yields. And I think the credibility from a sustainability is definitely picking up with what's been happening. That real yields will, on the back of that, kind of drop. And in that environment, the whole trade-off between holding linkers and holding credit changes. The dynamics change, and then when those dynamics change, then you start to think about, okay, I'm no longer generating inflation plus 5 from a very simple portfolio. I'm generating inflation plus 1.5, 2. I'm not saying we'll get there, but let's just go with that. I need to think about other ways that I can introduce carry into the portfolio. So it's really a time and a place. Right now, the time is just to sit back, hold linkers, and I know it's as frustrating as against the industries that just do nothing. Just hold it, keep it simple, and that's very much what's driving our asset allocation at the moment. So I just wanted to kind of add that to what Warren was saying.
It's probably one of my favourite expressions in markets. KISS, keep it simple, stupid. And to your point, I think a lot of people in our industry, all of us, try to look busy and then try to do things, and sometimes doing nothing is
the best thing,
honestly the
absolutely.
best thing for clients. And Warren would know, sitting in front of clients, sometimes not touching a portfolio is what you should be doing.
Yeah, the best thing we can do today is nothing. That's
Yes.
it's the best answer to give the client in most instances, and the one they really don't want to hear when something's gone wrong. And it hasn't gone wrong, it's just a volatility.
Yeah,
So it is a hard thing to say, but probably a great thing to do.
And even from our perspective, if a manager's doing what we appointed them to do, they don't need to be busy. They just need to keep on sticking to the mandate, making sure they do the best at what they're good at. And then it's easy to keep them in the portfolio. It's easy to explain to the advisor and the end client what to expect from this portfolio. And also we know where the risks lie. So what will happen to this portfolio or this fund when interest rates move up or down? What will happen when there's no issuance and you want more inflation linkers in the portfolio? Or when nominals suddenly aren't delivering what you were used to getting? I think all of us would be quite comfortable if we're able to talk the same story over and over again, because it means that we made the right decision by investing in that particular fund for a client.
And I'd be able to understand it.
Yeah, and we'd be able to understand it.
Nice try, Warren. I don't believe you for a second. Okay, thank you, everyone. And I think this is far better than reading a fact sheet. So hopefully everyone listening to this today will have learned something new about the 10X Income Fund. Thank you.
Thanks, Joe.
Thanks, Joe.